Welcome to The Big Break Show, a podcast where we discuss short-term rentals, entrepreneurship, life, mindset, and everything in between. Here are your hosts, Rafa and Jesse Vasquez.
What's up, everybody? Welcome to The Big Break Show, episode number 5. I'm here with my co-host, Mr. Jesse Vasquez. What's up, brother? How you doing today?
What's up, party people? I am doing good. And dude, I'm super pumped about our guest today, Malaki Sims, who's a real estate investor. He's a developer who focuses on opportunity zones. And not to mention, he's also a CPA. So I'm super pumped to have him on. Opportunity zones are something that I feel like a lot of investors don't know about, especially if you're new getting started. So please pay attention to this one coming up.
Dude, I know. Listen, man, I've been friends with Malaki for about, I don't know, like 7 months or something. I met him on Clubhouse, and this guy is probably one of the smartest dudes I've ever met. I mean, this guy knows how to work systems so good and how to place things strategically within the CPA realm of things, taxes, and what he talks about opportunity zones today is gold, right? And he's also now a short-term rental operator. So without further ado, guys, I hope you enjoy the show. If you're following us on YouTube, please hit the like button at the end if you like it. If you didn't, we'll try better. Other than that, thanks for being here. And here we go. So Malaki, man, thanks for being here. I really appreciate it. Thanks for taking the time and joining the conversation here at the Big Break Show. So basically, we want to start off the show by just asking who you are. Tell the audience a little bit about you. What made you get into becoming a CPA, a real estate investor, developer, and then we want to get into the nitty-gritty of the conversation of, you know, investing, short-term rentals, opportunity zones, and everything in between there. Cool?
Yeah, sounds good. Thanks for having me on. You guys have a great podcast. I'm excited to be a part of it.
Appreciate it, man.
We're happy to have you on, man.
Yeah, so I'm a CPA and a real estate investor and developer based here in Houston. I've been in the field of accounting for approximately 20 years, and that led me to a career in real estate, mainly because of the tax advantages that come with investing in real estate.
Got it. So you actually got into real estate just for the tax advantages?
That's the main reason. So looking for, you know, things to invest in and create passive income, more so generational wealth for my kids. I was trying to find, you know, the best avenue for that. The tax code is, you know, really advantageous to folks that own their own businesses and real estate in general, those who, you know, hold land, control assets. As far as how you can pass it down to future generations, it's kind of like cheating. So, you know, I wanted to take advantage of that.
Awesome, man. I love it. So 20 years in accounting, like,
yeah, 20, it's 21 years, I think. Yeah, 21 years.
Okay. And is it just because you like it, like the numbers side of things? Like, why specifically did you stick to that path? Like, I'm just curious.
I do like it. So accounting, people really think it's a lot of math involved, but it's really not. It's really kind of like a special language that kind of deals with the placement of numbers and, you know, where things are supposed to go and the process of things. So I'm an auditor by nature. I started my career out in the field of audit. I actually worked for Enron and Arthur Andersen here in Houston when the office closed. Yeah, so
that's awesome.
Yeah, so I started off with both of those companies in the field of audit, and then so when you're doing audit, you're not doing general day-to-day accounting. It's more so like you're going to different companies and kind of learning how those companies run and how the process works. So every time you go on a new company, new case, you kind of get to learn something new in a different type of business, a different set of rules, a different set of accounting. So that's why I like it.
That's awesome, man.
Yeah, that's kind of what this has been.
I'm glad you like it because I know that every time I have some like random like CPA question or something I'm confused about, you're always my go-to guy and you're super helpful about it. So I appreciate it. What actually made, yeah, man, no, I really appreciate it. So what actually made you want to be a CPA though? Like what's like before everything started, right? Like before you got into everything, what made you say, this is the path I want to take? Because we know why you got into real estate investing, right? For the tax advantages, but why a CPA?
Right. So it really started in high school. I went to an engineering high school here in Houston. Booker T. Washington is the oldest Black high school in the city. And they had a magnet engineering program, which is the top, one of the first magnet programs in the city and one of the top programs for engineering. I sucked at engineering. I was absolutely horrible at it. And my freshman year English teacher eventually became the coordinator for the program. And my first year, I thought that I was so smart that I could go to class and not do any work and pass everything with like a 70. And I thought that was cool, right? That you don't have to study, you can still pass. And that English teacher kicked me out of the engineering program and made me go to the regular program, for a semester and work my way back up. Then when I worked my way back up, I was a little better. I was doing my work, but I was still struggling with engineering. And she noticed that I played fantasy football and fantasy basketball at the time. And back then, this was in the mid 90s. So, there was no spreadsheets, no Excel, no internet. So we're tracking everything by hand. And I was using my engineering, paper to kind of keep the books and records for the league at that time. And she was like, well, you suck at this engineering thing, but if this is what you like to do for fun, you might like accounting. And she let me take one of the accounting courses my junior year. And I found out that I liked it. Like I said, the order and structure and just like the placement of numbers and the process and where things go. And that's where I fell in love with accounting at that time. Then I went to Morehouse, majored in business. And folks always said, if you're going to major in business, the field that will have the most interest is accounting, because accountants, you can kind of do finance, management, you can kind of do the jobs of everyone else. Everyone else can necessarily do your job. So that's why I chose accounting. And obviously, if you're going to be an accountant, you might as well, try to be the best one you can and get a CPA. So I did that too.
Most people don't find out what they want to do in high school, man. Like I didn't. Rafa, did you know what you want to do in high school? Like I didn't know that. So that's cool that you actually had that path that took you right down where you were going to go right out of high school.
Yeah, right. I was real fortunate that I had a teacher that, again, it was an engineering school, right? So that's the focus for your students. But she was really good at, at making sure that we find something that you'll like. And her idea was, if you like something, you'll work hard, you'll stick with it. So I'm really appreciative that she was able to, kind of point me in the right direction to just say, this is kind of what you like to do for fun. It aligns with the skill sets, align with this field. Try this out, see if you like it. And that's what good teachers are for, right?
I love that, man. That's so cool. Yeah, that's really cool. I mean, it's funny that it came from fantasy football, though, right?
Fantasy football, mid 90s.
That's funny.
Before it was cool.
Before it was mainstream. It was cool. Yeah. That's awesome, dude. You were talking about when we were saying you got into real estate investing for the tax benefits of it because you're good at, CPA stuff and tax strategies and everything. I mean, to me, it's complicated, right? Like it's beyond me. Like if I have a question, I always call somebody, right? You or my bookkeeper or somebody else in between when I have questions about specific things. But for most people out there, even just to become a real estate investor, it's very difficult and challenging, right? What made you be like, hey, I'm going to try real estate? I mean, you had a purpose to say, hey, I want to try it for the generational wealth part of it and for the tax benefits that we can get and all that involved. But what made you say, hey, I'm going to give real estate investing a shot? Like where did this happen? Like where did that transition happen in those 20 years of you being in the CPA side of things?
Being in the right place at the right time, honestly. So I got pushed and nodded over and over again by my good friend Onaje Barnes. OJ.
Yeah, love OJ.
He started out, OJ and I went to college together. We're in the same fraternity. So I pledged him into the fraternity when he was an undergrad student. So we've been friends ever since then. And so coming out of school, he was involved in real estate investing, but he's the type that likes to get his hands dirty. Like he does, he manages all his projects himself. He'll go out there and, put up drywall, drill in concrete, all that stuff. I don't do any of that. I hate all.
You and I both, man.
Yeah,
you and I both.
I hate it all. But OJ was involved in real estate first, and he was always kind of prodding me, like, "Hey, you need to buy a property." We're both on the generational wealth tip, But at that time, I didn't have any children to create generational wealth for, so it wasn't really a priority for me. And I was working another case with a guy who was a doctor, but owned a bunch of real estate. And just, working on his books with him, talking to him every day, he would kind of talk through, most of the benefits of being a real estate investor, just as far as how it was saving him money, how he was offsetting some of his regular income with, owning property and not having to pay as much in taxes. So that kind of piqued my interest on. And then when I had my first son in 2012, my good friend Onaje came to me and told me, "Hey, Malachi, I found the perfect house for me to buy. It's only like $30,000. It doesn't need much work. Wow. It's pretty much move-in ready. It's gonna rent for like $900 to $1,000 off the bat. It's the perfect house." And I was like, "Oh yeah, man, that's wonderful for you. When are you gonna buy it?" And he was like, "No, I'm not gonna buy it. You're gonna buy it because you have a kid now. So I know you're lazy as far as fixing stuff up, so it doesn't need much work. And I know once you get in the game and see, how manageable, how you can manage this and see how much money you can make, you'll get more involved and start doing more and more and more. So go ahead and start creating that generational wealth for your son that you just had and buy this house." So I bought the house. His wife was the realtor. OJ was my contractor to help do the light rehab. And that's how I got started.
We talk about all the time, like the people around you, right? People that bring you up and everything. And that's awesome. I didn't know that story. That's pretty cool. And I talk to you guys quite often. So that's a really, really cool story to know. Okay. Well, how do you go from buying this one house to becoming a developer? I mean, I've stayed at one of your properties, right? And they're very, very nice. And I know you've got a bunch of stuff going on. So like, where did that happen?
I appreciate it. I'm glad you think it's nice. You helped me furnish the whole thing. So it's kind of, you're kind of the reason why, at least internally, it looks okay or good enough for you to stay at. So I appreciate that. I actually got involved in development by getting screwed over by a developer. So
okay, how did that happen?
Yeah, so at some point in time, we kept buying houses, adding to our portfolio. When I say our, I mean myself and my wife. So all of our houses, we don't do syndication. We don't really have partners. It's just really us two. It's a family portfolio. Eventually, my wife saw the houses that we were buying and rehabbing, and she said, "Hey, these houses look better than our house. So, we need to go ahead and build a new house, a nice new house." So we started building the house. We picked a builder that was completely horrible. Essentially, he underbid us, and he underbid us, but my lawyer, one of my best friends, my lawyer, had a provision in the contract that made the builder responsible for all cost overruns. So since he knew he underbid us and he was responsible for the cost overruns, it seemed like he was trying to get himself fired so he wouldn't be responsible for that. So he was kind of, not really doing his job to complete the house. So I had to talk to the bank and basically take over that project, mid-project, to kind of manage it, and had good friends like Onaje, to help out, throughout the process. And I have a pretty big house. So while going through the process of building that, one of my other real estate mentors who designed my house kind of, nudged me and said, "Hey, if you can build this, then you can build something smaller, kind of like where you stayed." And again, my background's in audit. So, once you learn the process and kind of get the process down, you kind of, can see what it's like and replicate it. So that's how I got involved in development. Kind of, getting screwed over on my own house, seeing how it worked, and deciding to go do it elsewhere. And then around that time, that's kind of when everybody started flooding to Houston, flocking here. And those homes, like their first home I bought for $30,000 cost, like $100,000 or so. So it was just cheaper to build something than to just buy it, ground up, to buy it off the market. It's cheaper to build it. And then the opportunity zone law came. And then once I saw that, I was like, oh, game over. I got to change the whole strategy and just go into development.
Eventually, at some point, I will be a developer at some level. Like that's something I actually really want to do. And talk to us about how that situation became something that I'm assuming you enjoy it now, but through that hardship, you kind of learned a new trait in a
Right.
sense. So are you doing other projects now through the development side?
Right. So like I said, we have a family portfolio. So once that happened, we acquired enough land, in the inner city to build 13 more homes, I'd say. So we're on home 2 and 3 now. I think we broke ground on the second 2, right next to where you stay, Rafa. We broke ground a couple weeks ago. So
yeah, I think you told me about that. Yeah, I remember.
So we're in the framing phase now.
So okay, how does it look when you're doing an audit, like auditing numbers on a development property over buying something that's like a bird deal where you can just buy, beat up, and rehab it?
So it's kind of the same process. Just instead of buying it, you build it. So you just the goal is to be into the deal with no money down, with like as little money out of pocket. So like I told you, where you stayed, I spent more furnishing where you stayed than I actually spent out of pocket building where you stayed. That's because you get to reverse engineer the process. So you kind of see everything's based on comps. So just think of it this way: a developer, most of them, sell the property that they have. So obviously they're selling it for a profit. So you can kind of say, I'm going to ignore that profit now, and similar to the bird method, just do a cash out refi at the end on the value of that. And as long as you can build, your construction costs are 75% or lower than what things are selling for, you can essentially build it for free. So you kind of look at it the same way. You just see what the end number is in both cases, and that kind of lets you know how much you can spend.
Okay, but isn't the process from start to finish like significantly longer?
It is, because it can't. Yeah, because if you're just rehabbing, you can just go rehab. You don't necessarily have the governmental regulations that you do when you build. Technically, you probably should sometimes, where they say you should pull permits for everything, and some people make that optional. But when you're building from ground up, it's not optional. So
you have to.
You kind of have to. It really starts when you buy the land. You have to see what the best use is for that land and see what the rules are, like what your setbacks are. Like you may have a 50 by 100 lot, right? But depending on how that lot sits and how many units you want to get on there, you may have a 10-foot setback in the front or in a 18-inch setback on the side, which, each setback kind of reduces the space that you have to put a structure there. So it kind of starts with that. Like once you see the land, you figure out what can go here. And then you gotta get plans done with an architect. You got to get all your soil surveys done and things like that to make sure the land is safe so you can get your engineering done. You got to run all that through the city and get all that approved by the city to say what you can legally build. You got to make sure the neighborhood you build with, the HOA according to their compliances, because they may say you can only build one house on this land instead of chopping it up and building 2 or 3 houses. So you got to make sure that's all okay. And then you got to actually pick the person that's going to, pick all the trades that are going to do all the work. And then you have to secure the financing to get from step to step, because you can get a loan like a construction loan, but they only pay after the fact. They don't pay for things during the course. So like you start off, you got to do your foundation. Well, someone has to pay to do the foundation. And then the bank comes out and says, okay, the foundation's done. Now we'll give you money for it, right? So you kind of need money for that phase. You need money to buy the land. You need money to build until your draws come. And then you got to get in a permanent loan. So you kind of got to orchestrate and quarterback all that. That's what makes it a little different. The bird method is kind of the same. It's just more regulation and more planning that goes from ground up.
Where you're funding that, is it hard money that you're basically using up front then to front those construction costs, or are you?
You can use hard money. I don't use hard money. I hate hard money. We use lines of credit. My wife and I have lines of credit. And we'll pull equity from another property, like a HELOC or something like that, and we use that for fun. Like say for now, PenFed has a HELOC that has a 0.99% interest rate for 6 months, for example. So that's like free money.
Yeah. So basically, why do you don't like HELOCs? I mean, you don't like hard money. Like is there like a reason behind it? Because I know a lot of investors now, that's what they use, and everybody kind of does things different. So
Right.
Yeah, I was about to ask that.
I don't like it. I mean, I should say there's a better way to do it. If your hard money, you should be using, if you don't have the credit, to get cheaper debt, right? So you can go to a bank and get a line of credit, and they'll range between 5% and like 10%, right? Versus the 18-25% that the hard money lenders are charging. So why not just go get your own individual lines of credit and be your own hard money lender at a cheaper rate? Or like I said, for a HELOC, a lot of times people say your main house isn't an asset. Well, that's not necessarily true. You get a HELOC, you can go, that Penn Fed HELOC I just mentioned. If I'm building a house, I can 6 months at 0.99%. You can't beat that. And then after that, it goes to like prime plus 1 or something. Like the rate might be 4.25 or something like that. Why not do that instead of paying someone 18 to 22%? So it's not that hard money, it's not bad. It's just that there are better options available. And if you have good credit, why not do those?
Yeah, no, I totally agree. It's like more of an intelligent way to do it. Not that the hard money way is not intelligent, but you're right. It's all about, at the end of the day, you're stretching a loan out for a certain amount of time. You're paying all that principal, it's just, or the interest, and it just doesn't make sense. You're absolutely right.
Right. It just gives you an option to, if something happens and say you build a house and you can't sell it, right? Well, I'm not in as much trouble if my interest rate is 0.99 and 4% versus the 18-25% that a hard money lenders charge.
Yep. Yeah, you're right.
Yeah, we talk about this quite often, right? Me and you, like you've been trying to get me to do some line of credit somewhere, and it's been kind of difficult. But I guess, do you have any tips in regards to what would be a good route for somebody listening? Could go, that's a great idea. What can I do? Like, what's the next actionable step for them to go, I'm going to try this out. I want to build an ADU in my back house, right? In the back, in my patio or something, but I don't have the money. I don't know how to do hard money lender, or maybe hard money is just too expensive. And they want to go and try the line of credit side of things, or maybe the HELOC side of things. Like, what's something that they can do that you can suggest to them where it would be a good idea?
Sure. So the first step would be get your personal credit together, because real estate, any lender considers it to be risky. So that you're going to have to rely on your personal credit to start off no matter what. So get your personal credit straight. Make sure you have a score as high as possible. Then make sure your debt to income ratio is okay. So start paying stuff down. Typically, the banks want to see you. I mean, they'll lend up to 50% of a DTI ratio. So I would get my personal income together, pay off stuff to get my DTI rate down. And then once you have that, you can go essentially shop yourself to banks and go in there and essentially leverage your cash or deposits to have them give you a portion of that back. So any deposit you put the bank, every dollar, the bank can lend, 9 or 10x that. So you can, kind of negotiate and ask them, hey, well, if I put $10,000 here, can you give me a line of credit for X amount, 2x or 3x that, or whatever? Because they're making money off of you anyway, off of your money. So they're just essentially giving you some of their money back. And if your credit's okay and your DTI score is okay, and your numbers, put it in a spreadsheet or something. So when you go talk to the bank, it's not a conversation of, hey, can I have this? But I don't know where I'm at. It's more so a conversation of, hey, here I am. I got an 800 score. My DTI is 20%. What kind of programs do you have, for someone like me? You can literally cold call bankers and just, walk them through your numbers and kind of get deals like that, or get lines of credit like that.
I love it, man. Okay. There's another question I wanted to ask you that I've asked you in the past, but I still don't understand it, and I can't grasp my head around it. What's the point of a construction loan if you still have to pay for every job up front out of pocket before you get paid for that loan?
Because that money is eventually, you want the money tied into something long-term and at the lowest interest rate possible. So if I build a house, and it's $200,000, for example, right? I don't want that $200,000 all on one line, because your utilization rate for what you borrow counts against your credit score. So if somebody says, hey, we're going to give you $100,000, and I borrow all 100,000, if someone pulls my credit, they see that I maxed out to the capacity, right? And that's going to count against me. But when it's wrapped in a construction loan product, it doesn't necessarily count against you like that, because those are interest only, and you're only really responsible for just that portion. Like, they kind of know what the point of a construction loan is, if that makes sense. It's just a better avenue of debt than having everything tied up on a line of credit or something. And the interest rate is typically always going to be lower. So you go from bridge to bridge. Once you build whatever you're going to build, then you try to get that into as cheap a financing as possible. The construction loan product's going to be a little cheaper than that. Then you roll that into something permanent, and that's going to be better. Something permanent and fixed, better than the construction loan. So you're just bridging from one A, B, C, D, from one to the next.
Got it. Makes sense, man. Okay. So, and that does it even matter if it's like, let's say you're using it only for the 6 months to a year, it's still better? That way you're saying, so that because of your debt to income ratio, correct?
Well, it's better because you're locked into something fixed. So, okay. So the other risk is, if I have this construction loan, let's just say the house is 200,000, right? They've agreed to loan me the 200,000. I know I can get that from them. We're in the loan, right? That's my max. These lines of credit, say the economy tanks or whatever, and the banks can start pulling those back. Now I got to find a place to park all this money, right? Because it's not fixed per se, like the construction loan is.
Got it.
So it's just less risky.
That makes sense. Cool. Okay. Yeah, I appreciate that. So I want to shift into the opportunity zone and the benefits of it, part of things, because you talked about it earlier. When you found out about that law, it changed everything for you. How so, and why is it so good? And like, why did it shift everything for you? It sounds like that was your big break in the real estate development side of things.
Yeah, it's a piece of BS legislation that should be illegal, but it's not. It's the ultimate cheat code to take advantage while you can. Essentially, so the Trump Tax Act, right, put this law into force, essentially. So the government says, hey, we have these areas in the country, right? Like, you guys are in California, right? So they say, hey, here go these areas in California that need some development. We want to see these areas get better, but we don't want to pay for it out of pocket. So how can we improve these areas? Well, hey, we can give this massive tax break, and it is massive. We can give this massive tax break to these developers that we know have money, and they can come develop the area for us. As long as it's brand new development or like new, then we'll give them this massive tax break for it. So each state got to declare where the opportunity zone areas are. That's essentially like a zone, like an area in your state, in your city, whatever. They get to designate where these areas are to take advantage of these tax breaks. That's essentially what it is.
Got you. So, and they're to my understanding, what I've looked at in my own cities, they're not the best neighborhoods to be in. So basically areas that need to be like gentrified or
not true.
That is not true. Okay. So that's
the majority
in my city. That's where they are. Yeah. They're like not in like areas that you would even want to buy in.
Some, yes. I'll put it like this. And Rafa's been here. Rafa, everywhere you were at in the city is an opportunity zone. Everywhere we took you to eat is in an opportunity zone.
Wow.
Half of inner city Houston, opportunity zone.
Wow.
Half of inside the inner loop of Houston, opportunity zone. So no, they're not all bad areas. Some of them are. That's why I say it should be illegal. Some of them are really, really, really good areas. There's some need work. Some need work. You know, some are the gentrifying type areas that you mentioned, but no, they're not all like that.
Yeah, I live. Actually, my house is in an opportunity zone. So I'm actually sitting in an opportunity zone right here, and it's right up the street from downtown, and downtown's beautiful.
Correct.
You know? So a couple blocks up the street is being gentrified too, though. So it makes sense. You're right. It could be both. Okay. Did I explain it, Jesse?
Yeah, no, totally. I think that's where it goes. That's where I was going is, and I'm glad to know that it's not just the areas that need to be gentrified. Like in my city, a couple cities over, I looked it up and, there's a map. You can pull them up on the city ordinance. They'll actually show you where those issues, where you can actually, pick up an opportunity zone, or if you're looking for real estate, it'll show you the map, kind of the area to do that.
Mm-hmm.
But yeah, no, thanks for the explanation. That makes sense.
Yeah,
for sure. So what's the advantages of purchasing in one of those markets? What's the advantage of that?
So you really can't purchase there. You have to build there or do
rehab
or significant rehab.
Right.
So it's three main benefits. The first one is, so you have to do it you can only invest with capital gains. Okay. And doing it that way allows the government to get a taste to tax you a little bit. Basically, if you have your money tied in the market somewhere and you're not going to cash out, you have to cash out something and give the government a portion eventually to be able to invest in this. So that's how they get to take some of the money up front. But the capital gains that you use, you don't have to pay. You get to defer the tax on those capital gains up until like 2026, I believe. I'm going off memory, but it's like until 2026. So it's 2021 now. I get to take $100,000 of capital gains from somewhere else, and I don't have to pay tax on it right now. I can pay tax on it in 2026, but I get the benefit of using that money to invest now in something else. And so instead of paying Uncle Sam now, I can invest that money now and pay him years later. Okay, that's benefit one. Benefit two, anything I build or significantly rehab, if I hold it for 10 years, I don't have to pay tax on it when I sell it until like
at all
until like 2046. I'm going off memory again, but I believe the year is 2046.
Wait a second. So you're saying you don't pay taxes on it if you sell it before 2046, or you have to sell it after 2046?
If I sell it before 2046, and 2046 is the day I'm going off in memory, right?
Okay.
There's an end off date to the end off year to when you have to sell. As long as you sell before that date and hold it 10 years, you don't pay any tax on what you on your gains. So if I build a house for $100,000 and 20 years from now it's worth $500,000 and I sell it, that $400,000 gain, I don't pay tax on it. Wow. That's benefit too, but that's not even the best benefit. So no depreciation recapture as well. So typically when you own property, and Rafa, this is why I always tell you about owning versus arbitrage, even though I like arbitrage too. But when you own property, you get the benefit of depreciation to reduce your income every month. You know, depreciate your asset 27 and a half years. It's like the government paying you back your investment, which is why I like real estate tax-wise over anything else, because it's one of the only investments where the government's going to give me my principal back over time. So typically the government says, we'll give you this principal back via depreciation, but if you ever sell this house, then you got to pay that back. You know, you got to pay a certain percent of that back via a tax. But in opportunity zone property, you don't have to pay back depreciation.
Wow.
Sale before 2046.
And so let me ask you a question really quick. With benefit number one, can't you essentially take your free gains, right, where you don't pay taxes for a couple of years or whatever, buy real estate, and then still get the write-off on that time? So by the time that it's time to pay those taxes, you can kind of cancel it out anyway because of the depreciation?
Yes.
And then you still don't have to pay anything back after the...
Yes.
Okay. And then I guess, man, this is crazy. And so let me...
It is crazy. So doesn't it sound like it should be illegal? Yeah,
I mean, cheat code for sure. I'm glad you're sharing it. I mean, you guys heard it here, guys. We got cheat codes on everything, especially on how to make a ton of money on just the tax side of real estate. Jeez. So you're saying you said you were going based off of memory 2046 or whatever day you're going off of 6 years. Is it set for the time of purchase forward, or is it just everybody out there right now? It'll expire 2046, so buy before that.
You have to build or rehab.
Yeah, sorry, build or rehab before
2020. The time to get all your development or significant rehab in, that end date is, I believe, 2026.
Got it. So there's
after that, there's a time frame for that. After that, you have until 2026 between 2046. And again, I'm throwing these years out off memory, right? But whatever that time period is, that's the time period you have to be able to sell tax-free. But you have to hold it at least 10 years.
10-year minimum.
Tax-free. But
you can sell it before, right?
Yeah, you can. But that's the crazy thing is, like most of, you can go in and say, this was my intent, and say something happens and you have to sell before that. There's no penalty. All you do is pay tax like you normally would have paid anyway. They're not going to penalize you for trying, and then, oh, this didn't work. 7 years down the line, instead of 10 years, somebody offered me $1 million for this property and I couldn't refuse. Okay, fine. You just pay the tax that you normally would pay anyway. No biggie.
No harm, no foul. Yeah, that makes sense. So do you right now, I mean, that seems like a really, for a buy and hold investor, I mean, that sounds like a no-brainer. You know, it really does. Every
buy and hold investor or person that does significant rehab should be looking to develop in opportunity zones. In the rehab that you have to do, you essentially have to match the value of what you bought, right? So if you bought a house, for $100, then you need to put $100 into it. But there's another cheat code.
Dude, keep dropping on us, please.
And again, all of this is just my opinion, right? Nothing, no actual legal advice, yada yada yada. Just my opinion. But the way the premise of the law works is it's tied to basis. It's tied to the basis of your property. And basis is essentially saying, if I build a house and this house is cost $100, that's my basis. Okay, that's what my depreciation is based on. That's the value of the house. That's the basis of the house. And the basis has to be for a business purpose. Now, if I go take grandma's old house, which has never been depreciated because it's never been used for a business purpose, right? You with me? It's always been a personal residence. It's never been a business. But if I convert it from personal to business and it's never been depreciated, and I'm starting the clock of depreciating that basis from day one, then I don't have to do any rehab because I'm converting something from personal to business, and you just go on with that.
So what does that actually look like, though? Like, what does converting to business look like? Is that putting the home under an LLC? I take Rafa has a house that he has stayed in his whole life. He's the only person that ever lived there. It's always been his house. And now I buy Rafa's house, and now I make Rafa's house an investment property. And now it's never been depreciated before. So now I'm depreciating it for the first time. Now it's a business house, not a primary residence. Got you.
And from how I read the law, and again, this is my opinion, that's now opportunity zone property that I didn't have to do any rehab to, because I just brought a brand new business into the market.
Wow.
Got you. So I have a follow-up question to that. So say, because right now, like a standard home, like if I was to find something cheap in my area, I'm in Modesto, you know, if I found something that was, let's just say $200K.
Right.
So you're familiar with the SB 9 rule that just passed in California. You're in Texas,
no,
so I don't even know. So basically you could purchase a property right now in California. We know there's a housing shortage, right? We all know that the U.S. has a housing shortage. California in particular, Texas, I'm sure that there's a housing shortage too. There is nationwide. So Gavin Newsom passed a law stating that anybody that owns a property that has, like, you know, land, or it doesn't even matter if you have a ton of property or a ton of land on it, you can actually convert a duplex in a residential area. You can convert into an ADU. Permitting is 40% less than when it was before. This all passed on October 31st. So I can buy a property in the opportunity zone for $200K, build a duplex in the backyard. You can actually parcel part of that off. So that would be considered, I'd have to gut the front of the house or do remodel or whatever it is. And I can also build on that back end another ADU or even a residential, you know, a duplex. So that would be considered, I'm matching the $200K that I bought the place for, putting $200K into it. And then with the SB 9 rule, I can actually, Malaki, I can parcel out that back end and turn that into I can sell that and still keep the front end. Yes, correct.
And that is as long as you match that $200K with $200K and $1.
$1.
Then that's opportunity zone property, and you hold that joker 10 years and you can sell it tax-free and not pay depreciation recapture.
Talked about opportunity zones. Now, you know, I know that, you know, you deal with businesses on a regular basis, and you saw the tax advantages that came along with, you know, owning real estate. What are some of the key, like, reinforcers that happen with a business? So, like, I own a business, Rafa owns a business, I'm sure you own a business. So what are things that we can do now that we own, as far as owning a business, that we can actually take and utilize? We know real estate's one of them, right? You know,
Okay.
we can use that. So when it comes to like writing things off, or business credit, which is another, like I'm barely getting started in business credit. And we know that if we leverage our business credit, I can take things off my personal liability into my business. So I can continue to buy real estate and not be hammered in that essence when it comes to my DTI. So can you talk to us a little bit about business credit? You know, I'm sure that you deal with this on a regular basis. So kind of give us some insights on business credit, why we should look at it as being so important, how we can actually help business credit, you know, build our business in a different way, and also how it can leverage us to be able to still purchase properties and not have to add extra DTI onto our, you know, onto our personal credit.
Okay, well, you kind of said the main benefit. So it's really a two-pronged benefit. The main advantage really, so you set things up in a business under a business entity, it's really for liability protection. Okay. You don't want things in your personal name, because especially something like real estate, right? That it's high risk, high liability. Every time somebody's at your property, especially doing short-term rental like you guys do, that's a potential case, you know, waiting to happen each and every time, right? So you don't want somebody to slip and fall or get in an accident, or like Rafa, like you had a gun, you know, wind up in the oven, you know.
Man, that's a crazy story. We'll talk about that at some point.
Right. Stuff like that. You don't want any of that to be able to come back on you personally, right? So that's why you want to have things separate in a separate business for liability protection. Now, the credit aspect of it, once your business is generating enough revenue, is to where that entity can transact for itself. Then, like you said, with your DTI and things like that, all of that debt's not counting against you personally. It doesn't mean that a bank can't ever come after you, you know, and try to sue you if you default and things like that. But at least they have to go through extra hurdles and stuff. But actually, I wouldn't. Again, we're talking about, you know, how much debt costs and the cheapest debt available and things like that. Every person is allowed 10 federal loans, you know, for real estate purposes. Mm-hmm. So that's actually the cheapest debt that you're going to get. Until you maximize your 10 personal loans, I wouldn't necessarily move on to the more expensive commercial loans. The typical commercial loans, you know, 20 years, typical personal loans like 30 with the lower interest rate. They have some 30-year commercial loans, but again, the interest rate, you know, might be a little higher. So you're essentially trading. You're saying I'm going to pay more to have it be separated and not under me.
Got you. So you just brought up a question, or you brought up something. When the business makes enough money, enough income. So what does that actually mean when the business makes enough income? You mentioned that earlier, as far as, you know, being able to take stuff off your DTI. You said when it makes enough income. It's like, well, what does that actually look like? When
it makes enough income for an entity to loan you money. So gotcha. When you go into a bank and say, hey, I want a loan, the bank's primary job is to make sure that we can get our money back. So how are you making money to pay me back? Right. So if that business doesn't show any revenue, then I'm not going to lend to that business, because I don't necessarily know if that business is going to pay me back. Now, if that business doesn't make enough revenue, but you personally guarantee the money, you know, then I'm going to lend. And then I'm not going based on the business income. I'm going off of your personal income. And then I know I can get my money back. And real estate's so risky that most banks, they're going to make you personally guarantee anyway, unless I think your business is doing like $1 million or something. I forget what the number is. But in most cases for real estate, they know it's so risky. They're going to make you're going to have to run your personal credit.
Got you.
You know, I just got this house that I'm closing on. We had to use business income to get qualified. And actually, this leads me to a question, Malaki, because we did a bank statement loan program, right? Which is still conventional, just different underwriting. But we had to use the income from the business for me to get approved. And so you being a pro at CPA stuff, what do you recommend, or how do you recommend people structure their, let's say they become full-time investors or full-time short-term rental operators like me, right? Jesse just did it. How do you recommend that going forward from the moment that they no longer have a W-2 job, they structure their entity with like their taxes and everything like that, so that they can qualify for loans in the future?
You really can't give a general answer to that question because it's all going to be based on your individual situation. Okay.
Got it.
Because so I put it like this. Take me and my wife, for example, right? We're both high wage earners, right? So we're both already maxed out for self-employment taxes, right? So we don't care about being in an entity where the income triggers self-employment tax because we're maxed out and we don't necessarily pay it.
Got it.
Make sense?
Yes, it does.
So that's going to determine that one thing alone will determine what entity structure we use. Does that make sense?
Yes, it does.
So it really depends on your individual situation. So when you looking at any endeavor, you have to see like, what's my end goal? So say, for example, if I know that I'm eventually going to want to buy like you are now and rely on getting bank loans, then I have to show that I have to be in a structure where I'm showing the bank that I have active income, not passive income. Make sense?
Yeah.
So that might make me pay a little more taxes, but now all of those funds, I can use all of those funds when I'm trying to qualify for a loan. You know, it's questions like that you have to answer. So it's always going to be the situation specifically tailored to your specific situation, and not just you, but you and, your spouse or others.
Makes sense. Got it.
Same thing for your business partners too, because, you and Jesse, you might have different motives as far as how you're trying to do things tax wise, and it's going to be some give and take,
Right. Yeah. And I think too, that once you actually run your business, and I didn't realize this until I started getting into these, these back end things, that, you have to structure your business in a way that makes sense. And I think a lot of us, when we get into business, we think like, oh, cool, we're just going to make all this money. We don't need to put any money aside for taxes, blah, 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 blah. And then all of a sudden it comes time to do your taxes and you're like, shit, I have to allocate X amount of money to taxes. Like, and we don't realize that. Like, I didn't actually realize that because I always had a W-2 job my whole life. So it was already taken out. It wasn't even a thought to me.
That's why I love the profit first system so much, because I put a percentage away for taxes every time I get money into my bank account.
Right.
And that helps, because with the type of revenue that y'all do as short-term operators, you probably should be paying taxes quarterly throughout the year. So, the government, the way it typically works, they take from your W-2. They're estimating based on what they think you're going to make. And at the end of the year, we're close, right? Either I owe you some money or you owe us some money.
Right.
You owe the government some money. You may owe the government a little bit of money, and they don't care about that. But if you owe them a lot of money, then they're going to say, hey, we wanted our money throughout the year, and you should have been paying us taxes quarterly.
Yeah.
So you may have to start paying taxes that way. But as far as business deductions, it doesn't, again, the entity setup is more so for liability protection. Almost every deduction that you can get on the business side, you can get as a sole proprietor, just running things through your personal tax return. You can get pretty much the same deduction. You may just have to, structure it a little differently. But if you spend X amount on an expense and it's a valid business expense, you're going to be able to write that expense off no matter what entity structure you're under.
I think what's important to know here too, Malaki, is that basically it's give and take, right? You're going to have to pay more taxes if you want to get approved for larger loans, right?
Yes.
Talking in real estate, right? So if I'm trying to avoid paying taxes as a business owner, then I'm probably not going to get approved for loans in the future from the government, right?
Right, correct.
So yeah, I appreciate that. Okay.
So basically, how people will use loopholes when it comes to business. They'll make 100,000 and they'll have 100,000 in write-offs, right?
That's dumb.
That's what?
That's dumb.
Yeah. Well, yeah, that's what I mean. So they're essentially showing zero income for the company.
Yeah, but let me explain why that's dumb.
Yeah, please.
So, and we see this all the time. A write-off, you don't get back dollar for dollar. You only get back whatever your tax rate is. So if I'm in a 20% tax bracket and I roll off $100, I'm only getting $20 back. I'm not getting $100 back. So what's the purpose of me going out to spend $100 to only get 20 of it back?
Right. Hold on a second, Malachi, because I want you to explain something. Because a lot of people are listening to this, like they're new, right? They don't know, like they just started businesses. They're doing things like out of the norm for them. When you say tax bracket, let's explain that part first, because a lot of people don't know where they fall on a tax bracket. Like I didn't know about it until it was explained to me, right? And that was like 2 years after I was already in business, where I'm like, wait a sec, because I was doing what you just said. I was being dumb. I was trying to write off as much as possible that I could. Come to find out that I was just spending unnecessary money. And you even to this day, you're putting it in my head. Hey, don't spend what you don't need to spend. Best advice you've ever given me, right? Correct. So with the tax bracket, like how do people know what tax bracket they fall under? Is there like a measure to it?
Yeah, just look on irs.gov and search IRS tax brackets, and you'll see the amount that you make and where you fall. So if you make between $0 and $30,000, you pay X percent. And then if you make $30,001 up to $60,000, you pay X percent. So you pay, I'm gonna just say 10, 20, 30, just for an example, right? Okay. So up until the first $30,000, I pay 10% of that income, right? Now it goes from 10% to 12%. I pay 10% from 0 to 30,000, 30,001 up to 50,000. I pay 12% of that. Okay. So 10% of 30, 12% of the next 20 equals how much I pay. Then if I go from 50 to 70, now I might be in the 15% bracket. So it's 15% of that portion. And you just kind of add it up. Now they give you things like, everybody gets a standard deduction that they can, offset a portion of their taxes. But if you have things, again, this is why owning real estate is so wonderful, right? Because if you own, one of the best ways to beat the standard deduction is from real estate. Like if you simply own your house, then now all of the interest payments that you make, you get a deduction for that. All of the property taxes that you have, you get a deduction for that. I mean, they capped it at $10,000. It used to be, a much higher amount, but if you own property, it's easy to beat. Well, it can be easy to beat the standard deduction and get more back of what you spend. So when it comes to why I said spending that money unnecessarily is dumb, you should only be spending money for your business on things you need. Get the deductions for things that you would spend money on anyway. It's the other type of deductions that you don't spend money on, like depreciation, which again is why real estate is so good, that you want the government to give you those type of deductions for things that you're not spending out of your own pocket.
Yeah. And to talk about deductions and depreciation, that's one of the things I love about short-term rentals, because correct me if I'm wrong, I can buy $20,000 in furniture for a new unit that I put up, and I can depreciate that at 100% for the first year. And then is that possible?
Yes. For the next few years, now we're still at 100% depreciation. In a few years from now, it's going to drop to 80%, and then it'll keep, going back down. But for now, yes, 100%. And most importantly, this is why you need to get with your CPA to come up with a plan, beforehand, before you start doing stuff. You said it the right way. You said, I can depreciate that furniture and get 100% versus expensing that furniture and getting the same thing. But when I go to the bank lets you add back depreciation. They don't let you add back the expense. So just putting it in one category versus the other is going to give you credit for when you go in and get financing.
Got you. Yeah.
Yeah. No, I think for us, we're doing anything under $700 we expense. Anything over that we depreciate.
Okay.
Something like that.
Makes sense.
I'm not sure off the top of my head.
As long as it has a useful life of 20 years or less, then you can get the bonus depreciation now.
Gotcha.
Got it.
And wipe away all that income potentially.
Gotcha. And
in an opportunity zone, wipe away all that income and never have to worry about paying it back. Well, not never, but for the next 20 plus years or whatever.
So Malachi, we're talking about on the business, like, financing and all that stuff when it comes to purchasing a property, not writing stuff off that doesn't make sense. Are we looking at that when we fall under tax brackets under gross, or are we looking at that under net?
What do you mean?
Like if I made $100,000, but I wrote off 30,000, so it would be 70,000. That would be the net that we're actually. That's the tax bracket we're under. Would be the net.
Well, you would be taxed on the 70.
So it's not the gross.
It's not the gross. So it's your income less your expenses equals the 70. And in that business owners, the expenses, deductions, they use the words interchangeably, but essentially they're writing stuff off. They're saying, hey, I spent X amount, so my income shouldn't be this because I spent it on this.
Yeah. And I hear that all the time when people will say, yeah, it's the end of the year, I need to go buy a car or truck that weighs over 6 tons because I need to add this to my expense or whatever. Mm-hmm. You'll hear that stuff all the time where people will, do things like that. So what would you say to somebody that's looking at doing that?
I'd say that's dumb unless you need the car.
Right.
If you need the car, buy the car.
Right.
If you don't need the car, don't spend $1 to get back 20 cents.
Right.
On something you don't need.
So Malachi, this year I'm actually going to go buy a new car at the end of the year, but because I need it. It's not because I want to buy it.
Yep.
And it's going to be a tax write-off on top of it, right? But yeah, I guess
you actually use your car for your business. So
doesn't it have to be over a certain amount of weight though?
It depends on the car, but yeah, for the most part, yeah.
Got it.
The tonnage. They have certain models, and you can find that. You could just Google what cars qualify for the tax write-off.
Yeah, they're usually trucks. It's 6 tons. I think that's what it was, if I remember correctly.
Right. But you use your car. See, that's the difference. You use it in business.
Yeah.
So that's okay. And all of these write-offs, there are some key criteria that you have to hit. It actually has to be for a business purpose. You have to use it for your business. It has to be an ordinary and necessary expense, basically saying any other business like mine would be spending money on this. Like, it's not weird that I'm spending money on this thing. My business needs it. I have to spend, not I have to, but it makes sense that I would spend money on this. It's ordinary and necessary. And the most important thing is it has to be reasonable, meaning it's not, some crazy cost. So, all three of us, we're networking. We need to go to dinner, right? Well, do I need to fly us out? And is it reasonable for us to fly out and go to Vegas to go to dinner to talk about what we need to talk about? No, not necessarily, right? Or I need a business card, but I sit at home all day and, build websites for people, right? So is it reasonable that I have a Lamborghini for my business and I sit at home and build websites for people? No. Is it reasonable that I may have a truck while I'm a short-term rental operator, going around taking furniture and setting up places to live and, for my guests and things like that? Yes. And then the most important thing is you have to keep your books and records for all of this stuff. You have to be able to support it because the onus for expenses is on the taxpayers, not on the government. They don't have to prove expenses. They prove income.
Yeah, that makes sense. I'm glad you brought that up too, because it's so important to have a good bookkeeper to keep track of everything, right? Like, I'd be a mess if it wasn't for mine,
Yes, but that also ties back into the whole, what you were asking about business credit. So if you have, things like business credit cards and things like that, it does all of that tracking for you.
Yeah.
And you just give that to your accountant, and there's your proof that you don't need 100 receipts. You need, here's my credit card statement.
Yeah, that makes sense. Malachi, you have your own short-term rentals. How is that going? What's that journey been like for you so far?
Thanks to people like Rafa, it's been great so far. Yeah, since he lets me bug him all the time with endless questions about how to set it up. So it's going great so far. We have 2 units on short-term rental. Actually learned about it, all on Clubhouse. Yep. And, through meeting folks like you. 2 so far, and the next 2 we build, we'll probably put those on short-term. It just depends. We'll see what the market's looking like at the time. But so far, I like it. I just don't like the capital outlay for furniture. initially.
Well, you know what though? You do something very creative because number one, you own all your properties, but aren't you tying like the cost of furniture to your cost of construction, so it becomes your startup cost?
If you try I try to roll as much into the loan as possible to have the loan cover everything.
Yeah, I love that, man, because a lot of people out there will go, well, it's going to cost me this much for a down payment, or it's going to cost me this much to build, and then on top of that, I have to pay this also. And you, again, being as creative as you are, you're saying, nah. It's the cost to build and the cost to furnish together.
Yes.
And it becomes operational.
Try to roll it all into one thing and get it all in a loan, so you don't have to come out of pocket for anything, and then your return is infinite. And when your return is infinite and you're not out of pocket, then it gives you the flexibility to try different things. Like I can say, hey, let's try this short-term rental and see if it works. Because if it doesn't work, the house only costs X. It didn't cost me anything at the end of the day, so we can give it a shot.
And let me ask you a question, because I mean, we know it works at this point, right? But based on you had 2 properties that were already constructed. Did you pay out of pocket to get them furnished, or did you use a line of credit to do it?
I used a line of credit to furnish them.
And how did that look?
Look fine. I mean, we've gotten a lot of the money back so far already. So, like I was telling you, for both of those properties, I think we went live in June for the first one, and like the second one was right before Labor Day, right, in September, I think. And we made more in that time frame than they would have made on long term for the entire year so far in those few months. And as you know, the place that you stayed at, because I discuss this with you all the time, we're in our slow season now for the past 2 months. So it hasn't even been fully occupied. Yeah,
and even slow season, you're still above what you would be normal on a long-term tenant anyway, right?
Yes.
Yeah, see, man, I love it. It's different because, you know, you guys all know I'm arbitrage. So to me, slow season kind of hurts because I still have to meet a bottom, like an expense ratio, I guess, that I have to cover. But when you own the property, what is it? I mean, I guess it's the same thing because my rent for me would be your mortgage for you, right? But it's just a significantly lower mortgage than if I was paying rent on it.
It's a lower mortgage, but I get to also write off the taxes and I get the depreciation.
Yeah, I love it, man. I love it. And again, it goes back to the end goal is always to get into buying and holding real estate, right? So
right. And buy and hold allows you to, do the whole generational wealth thing, because that magic word depreciation, that magic clock, as your property goes from generation to generation, that clock starts over again and over again and over again. So if I have a house now, it costs me $100. I can depreciate that $100 over 27 and a half years. When I die and my son inherits that property, now it's worth $500. He can depreciate that house, that $500 over 27 and a half years. When he dies and his son has the property, now the house is worth $20,000. He can depreciate that same property 27 and a half years, unless they change that law, which they haven't changed, and I don't see why they would. But depreciation is the magic key for generational wealth.
Yeah,
and that's free money. I mean, there's not any money that people are spending on anything. You're just basically the government is basically saying, hey, this is what the house is worth, and we're going to give you a break for it.
I love it, man. I love it. Listen, we're on the top of the hour here, so I don't want to keep holding you up. But I really appreciate you coming on here because, man, just the opportunity zone talk of things. Like, I wanted to talk more about short-term rentals because, that's what I'm all about. But it's okay, maybe for another time. But I got to ask you, with all of this, based on what we're talking about, and we asked this to all of our guests to come on the show, and I kind of brought it up a little bit earlier, but what was your big break, right? We named the show The Big Break because for us, our big break to have that financial freedom, that time freedom, that mindset shift, whatever the case may be. What was yours specifically to what you're doing now?
Sure. My big break is what I mentioned at the beginning of the show. When a great educator Vicky Cave or Vicky Flannery, rest in peace, focused enough on me to tie in something that I was doing as a hobby into something that I could make a career out of when I was struggling in her engineering program. And if it wasn't for her doing that for me, then I never would have become an accountant, I don't think. So
I love it, man. And that came at such a young age too. That's awesome, dude.
Yeah, that's super
awesome.
cool.
I love that. Sweet, man. So tell us, Malaki, and let all the listeners and viewers as well, for the guys on YouTube and ladies, something that they can take right now, an actionable step towards maybe finding an opportunity zone location, or maybe getting their next development deal, or maybe just learning about opportunity zones, whatever the case. Give us an actionable step where they can take, learn, and apply the moment this podcast ends.
Sure. So go Google opportunity zone map and just look at it and look and see what areas near you are actually in an opportunity zone. And you may be very, 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 very surprised to see how many very nice areas near you are in an opportunity zone. And then as far as investing goes, get your credit in line, get your DTI in line, and that way you can start investing, you know, without using all of your money, but kind of leveraging other people's money to go ahead and start.
Jumping in, talking about all these things. I know that, you know, the tax situations and things like that, business, you know, on the business end, you know, a lot of people, especially as they're getting started, they're listening to us. You know, this is a lot of information for them to use and understand as they move forward through their journey with investing in real estate and all that stuff. So I appreciate you being here, man. No
problem. Thanks for letting me come again. You guys have a great podcast. I'm proud to be a part of it, and want to note one last thing that I should have mentioned first. When you mentioned the taxes, I say actually step one before you start investing, get with your CPA and get structured properly initially.
From day one.
Smart. One. That's a big one. Yes, for sure. I'm glad you brought that up, actually.
Yeah. Cool. People will avoid that all the way to the last minute. And then when it's too late, it's already done. You know?
I wish you would have told me that 4 years ago, Malaki, because I'm still working on that right now, man.
Hey, blame Clubhouse. I didn't know you 4 years ago.
True. Hey, I'm happy I met you on Clubhouse, man. This has been awesome.
Man. It's been great. Like you guys are great. Y'all are killing it. I love to see it, and I really appreciate that. You know, you guys freely share so much and tell people, you know, no stingy energy, you know, like others say, you know, you can, you know, share and, you know, it'll all come back to you.
Yeah, for sure. It's funny because we were just talking about that in a prior interview too. I'm a big, you know, you hear me say this all the time. You help enough people get what they want, you in turn will always get what you want, and it's paying off, man.
Yeah,
I'm trying to help as many people as I can, and I'm trying to give as much as I can because I know it's coming back for me. Amen. But anyway, Malaki, let the people know, man. Where can they find you if like they have more questions about opportunity zones, or they just want to reach out or follow you on Instagram? Like, where can they get a hold of you?
On Instagram at The King Malaki.
Okay. That's it. Cool. All right. Awesome, man. Yeah, we'll put it on the show notes for everybody as well. Other than that, I mean, Jesse, any final thoughts, man? Malaki, anything?
I think it was great, man. I'm glad you were on to be able to talk about all these things that again, a lot of people wait too long to get started when it comes to certain things like this. So I appreciate you for being here, man.
Thank y'all. Again, thanks for letting me share my personal opinion on all of these matters.
For sure.
Awesome, man. Thanks. Well, have a good rest of your day. We appreciate it. Stay safe.
All right, y'all too.
Thanks, man.